Good afternoon, folks. Welcome to today's session. Appreciate you guys joining us. Today, I'm going to aim to probably chat for about a half an hour, maybe a little bit longer. Give you a little bit of an economic update, and then also talk a little bit about just how taxation on your statements and reading just the numbers. Just give you a couple of examples. We've been getting a few different questions coming out of tax season. Thought it might just be helpful as a refresher. I guess before I jump into it, if anybody has any questions, you can key them into the Q&A box. If you're on a laptop, it's generally across the bottom. If you're on a iPad, iPhone, I'm not quite sure, it'll be on one of the screens. So just key it in. I will do my best to answer them as we go through the session today. If I don't get to everybody, I will do my best to provide some email comments after the session. But again, I do encourage any questions that you have as we're going through these slides to pass them along, or if something else comes up that you have questions on, feel free to share them. So just three things we're going to chat about. The first two really are about the markets and just the economic outlook, more so from a central bank point of view. And then, like I said, we're going to talk a little bit about how distributions and book value adjustments impact your statements and how to really assess the performance of an underlying asset. So we'll start here. I usually start my sessions with with the slide like this. I thought this one was ideal given the fact that the economic data in the US just came out. I will talk about that here shortly. So just to recap. So yeah, what a difference 1 month makes. I mean, obviously lots has changed over the last 5 to 6 weeks since our last session. The biggest thing in the last session we were talking about was, we were just in the early stages of the temporary ceasefire, which was a 30-day period where it gave them an opportunity to negotiate some sort of deal. As you know, they're still dealing with it. But that being said, I think we were about 9 days into it. Markets had already started to turn the corner and started to improve. And the last 6 weeks, they actually have posted very strong results. For those of you that are starting to receive the April statements here, you're going to recognize that in the numbers. And there's a couple of reasons why. So, and I've talked about this, there's just two kind of markets going on right now. There's the event-driven market that has been impacted by what's been going on in the Middle East with media news, with new announcements and so on. We recognize that markets do not like uncertainty. So when we're not quite sure how things on the geopolitical side are going to impact corporate earnings and so on, we tend to see volatility, and we saw that through the month of March. The second part of the markets that we're seeing is a more fundamentally driven market, and I've been seeing this now, going back even to 18 months ago when trade policies and tariffs were being announced. We often said, hey, there's event driven and there's fundamentally driven. And what we recognize is that the economic numbers, the corporate numbers, are actually decent. And as the geopolitical risks subside or the news gets more positive, what we're going to see is the markets are going to defer back to fundamentals. And what it told us over the last number of weeks with corporate earnings is that generally it's actually quite positive. So this slide here just talks about the different sectors that have been reporting for Q1 2026. The green bar that you see there, that's the percentage of companies in each sector that are exceeding or above their actual earnings projections. Yellow was in line, and then the red one up top is the ones that are below. Now, what's interesting is we, Q3 of 2025, Q4 2025, and now Q1 of 2026, each quarter has actually stacked up on top of each other, and things have been getting better and better. And this time around, these corporate earnings have actually come out at a historical pace in terms of what's been reported, way stronger than anticipated. And this is what we're seeing. It's almost like cooking with gas. You throw gas on the fire, and we get some positive news out of the temporary ceasefire coupled with a really positive corporate earnings. And here we are with one of the best 5 to 6 week stretches we've seen in recent memories in the markets. Now, we actually look for the second part of the earnings story, not just about the numbers, but is what their anticipated growth is on the go forward basis. So what's their outlook looking forward? And generally speaking, they're positive. So in the past, where some of these companies have given guidance because they've been a little bit nervous about how, tariffs or trade policies or the rising cost of oil and energy, how that might impact future corporate earnings, where we've seen them come out and say, "Hey, we're not sure, so we're gonna actually roll back our guidance or our positive outlook." Markets, companies, their prices have gone down, they've shrunk. Well, here what they've done is they've come out and they're very optimistic about what those earnings numbers are going to look like on a go forward basis. And so what this chart shows us here, again, it's broken down by sectors. And if you actually look at corporate earnings, which is on the vertical axis, okay, or the percentage of the change in the earnings, and this is the price change within the stock price. And so what we see, when we actually look from the more conservative outlooks to the more optimistic outlooks, the more optimistic the outlooks have been, the stronger the performance has been since they've announced. Okay, so again, we actually see this. So we anticipate fundamentally, I said at the beginning of the year, I said, hey, the last 2 to 3 years have been pretty good. Can we actually have, a fourth year of pretty strong returns? I said, hey, if we get a good strong single digit, low double digit return in the market, I'd be really pleased. We're already there. The NASDAQ is sitting at just roughly 11%, 10 to 11% for the year. And we're coupling with that with a positive outlook. So here's where the markets stand year to date. I've included the bond market here. Again, for most Canadians, they're actually owning bonds to offset the risk of their equity portion. So unfortunately for a lot of Canadians, they're owning a portion of equities and they're owning fixed income. It's that those traditional asset classes, stocks and bonds. Generally speaking, in Canada, 60, 70% equities, 30, 40% in this fixed income, which is not done very much, not only year to date, but over the last 5 years. The benefit for the folks on this call, for at least our clients, we have been using alternative asset classes outside of traditional fixed income that have been yielding anywhere between 6 to 8% in lieu of fixed income, which has been strong. Then we look at the equity markets. Obviously, the NASDAQ has been the strongest so far. And then again, North American Dow is the weakest, and the S&P and the TSX fall right in between. Okay. So let's just unpack a little bit about how the impact of this conflict has been. The biggest thing is on obviously oil, and then the trickle down effect into the energy prices and so on. So when we actually look back at what's happened in this geopolitical event, the closure of the Strait of Hormuz is by far, if we go back, in these other events that have affected oil, it's been the most significantly impacted event that we've actually seen in our lifetime. Okay. And a big part of that obviously is with the Strait of Hormuz closing, the traffic level and the shipment of oil out of that region is, and not just oil, but just goods in general, fertilizer and so on, natural gas, has actually fallen to pretty much a standstill. And this is obviously problematic for a number of different reasons. I'll get into the inflation numbers in a second. But where do we really look? Where do we go from here? Once they get a resolution, do we think things are going to get back to normal right away? I don't know. I'll show in the next slide here. The biggest thing right now with this slowdown is the price of oil. It's the worst kept secret. Anybody that goes and fills up your car, it's expensive. Again, this is, you might look and say, well, oil isn't at this price right now. We try and, when I did this, oil fluctuates so much on a daily basis. Again, this is just a fixture in time within the last couple of weeks. What this chart shows us is currently it's elevated, but when we actually look out over the long run, we see a much more gradual or we see the price coming down long term. This is why a lot of analysts feel that this spike in oil is somewhat transitory and that we're going to actually see it revert down to where, it's going to be likely some, $70 or so. But again, the longer this stretches on, again, the more that the high price of oil is going to trickle down in goods and services and so on. So back to what I was saying, do we think the Strait is going to get back to normal? And what's interesting, if we had a resolution today, we're not going to see traffic increase significantly with a resolution. It's going to take time. So, here we are. This was one that was in April 30th. It's still closed. So these numbers effectively will get stretched out into July, August, September. So the longer it goes on, again, the higher gas prices and everything else will stay. So let's actually just look at, so the biggest thing, CPI inflation came out in the US. I'll show it on the next slide. This is something that we talked about last time, but we can see the direct correlation to the inflation numbers and the price of oil. And this, again, I spoke about this, 6 weeks ago. Well, here's what the actual data is telling us. We just had US inflation announced yesterday. It was the biggest jump in 3 years. We're just a hair under 4% right now. When we reduce or take out the food and energy numbers, it's sub 3%. But the biggest impact on the inflation numbers is food and energy. And so a lot of analysts I just read this morning, they think it's going to touch 4, maybe even creep over 4% here in the near term, which is problematic when it comes to Fed policy, which I'll talk about in 2 slides. Okay. So where is the U.S. inflation by category? Again, it's all in most of it's in the energy piece. Gas, electricity is the 2 big ones. Again, biggest challenge here is these will likely stay elevated as oil is up. Airline fares obviously have increased because of oil. But what I think is interesting, and it's not being reflected yet, but these food costs here we can see have come up. I think this is only going to get worse. This is the reason I think inflation will touch 4% or maybe even go past 4%. Is simply because a lot of transport for these goods and services, the oil, the price of gas, and so on, companies are not going to absorb that cost and impact their profits. That's going to trickle down to the end user, which is you and I. So I would anticipate these numbers in here will also start to significantly increase if we see this prolonged closure of the strait. Okay. Now, how does that impact us? I think what's interesting is, 2 major banks in the U.S. yesterday came out, Goldman Sachs and Bank of America, and they revised their forecast for rate cuts out of the U.S. Goldman has deferred any rate cuts until next year. They anticipated they might see 1 to 2 out of the U.S. this year. It is now, they're anticipating it to maybe not happen until Q1 or Q2 of next year. Bank of America still thinks there might be 1 by the end of the year. We could also see a rate increase, which wouldn't be a surprise. I don't think the markets would digest that already well coming out of 2022, where we had inflation rates at 8 and 9%. So I think the U.S. Fed, will do their best to maintain them and maybe even squeeze 1 rate cut in by the end of the year. But it wouldn't surprise me at all if we have 0 rate cuts this year. Sitting for Canada, obviously the Bank of Canada is watching the economic data closely. We didn't anticipate really too many further rate cuts from them. We actually thought we might get 1 this year. But generally speaking, even if you look at the chart, Canada cut at a much quicker rate coming out of 2022, 2023. The U.S., they held tight for quite some time, and they only started cutting, mid to late last year. So from a rate side, I wouldn't anticipate many rate cuts, maybe 1 if we're lucky. Okay. So with that, I'm going to switch gears. Again, it's just more of an overview of the economic outlook. I think we're in a pretty good spot right now. If I could just summarize it, markets, again, are reverting back to more of the fundamentals. We are more optimistic than what we were 6 weeks ago, but we're cautious still because, again, the U.S. Has commented that, they may restart their campaign against Iran. And if that does happen, obviously it creates some uncertainty. But I think the media, I think people, I think investors are digesting that negative stories at kind of a little bit of a less of a pace. We're not seeing as significant moves in the market when negative news comes out. And I think part of that is because, we learned this last year, it's deja vu. Trump came out with trade policies last year, came out with tariff talk. And what he kept doing was, he kept pushing it out, further and further. And I talked about this before. They coined it the taco trade, which is Trump always chickens out. To a certain extent, that's what's happening now. So again, the ceasefire, there's a date that or the deadline keeps getting extended. And so when they talk about, or when he talks about his administrative perhaps, reinitiating, the campaign in the Middle East, I don't think the market's already digesting it at the same pace as what they were before. And I would anticipate that, on a go-forward basis. Okay. I'm just going to check any questions. Yes, I have one. Yeah, you know what? Somebody's just asking about the sovereign fund that Canada had recently announced. I'll actually save that question for the end. And I said any individual investments into this fund. My only comment would be it's very preliminary, and at this stage we don't really have too much information on it. So, all right, let's talk a little bit about understanding statements. And for some of you on this call, this is just going to be a refresher. But I think there's going to be some bits in here that might be interesting. You might maybe create a little bit of an aha moment. So the next 3 slides, they're all refreshers. So I'm just going to go back and I'm just going to talk a little bit about taxation. We all want to minimize tax. We just went through tax season. We filed the taxes. We want to make sure that we're trying to reduce or minimize as much tax as possible. So CRA isn't putting it in their pocket. We'd rather keep it in ours. So first thing, 3 main types of accounts. I'll go through them really quickly. So there's a taxable account, tax-deferred accounts, and tax-exempt or tax-free accounts, okay? So a taxable account will be a traditional brokerage account, personal or corporate, hold securities, can be a mixture, stocks, bonds, pooled investments like mutual funds, ETFs, etc. In these types of accounts, these investments are taxed as you earn distributions, which could be dividends, capital gains, interest, return of capital, or when you trade investments and you realize a capital gain or loss, okay? Now, we all just went through tax season. These are the types of accounts that would distribute T-slips, okay? And you pay tax along the way. Second one is tax-deferred accounts, RSP, RIF, LIRA, LIF, IPP, RESPs, RDSPs, which is a registered disability plan. So all of these types of investments, all tax-deferred, any income you earn within that account, you don't pay tax on, but when you draw it out, you actually pay tax on those withdrawals, okay? And then the last one is a tax-free or a tax-exempt, which would be a tax-free savings accounts or a TFSA or an FHSA, which is you get a tax deduction and tax-free growth, which is meant for a first-time home buyer. So for people that have, children, grandkids that you want to save money for a purpose of a house, if they are age majority, which means in BC they're 19 or older, they can actually, you can actually contribute, I think it's up to $8,000 per year. You get a tax deduction like an RSP, but you get tax-free growth like a TFSA. Okay. These types of accounts, you can invest in them. Same thing like the taxable accounts, stocks, bonds, pooled investments, ETFs, and so on. Any growth that accumulates in there, fully tax-free. When you take it out, fully tax-free as well. Okay. So important to understand how your accounts gets taxed, first of all. Second one is how are distributions taxed? And I'm going to focus on 4: interest, dividends, capital gains, and return of capital. And again, these are all refreshers. These are things that we've talked about in the past. So interest income, and I'll give you an example of the dollar amounts in a second. Interest is taxed at a full marginal tax rate. In this case, we're using roughly 54% to show this. Interest income on a GIC as somebody in a top tax bracket, and they would lose 54 cents on the dollar. So every dollar of interest they earn, they would pay the government $54 or on $100, and they would keep 46. Okay, so the government actually makes more money on your interest earnings than what you would if you're in the top tax bracket. Okay, capital gains, which is below, half of it's taxed. So to go back again, if you actually invest in something, let's say you own a property, you buy it for $500,000, and it goes up by $100,000, and you sell it for $600,000. That $100,000 realized gain is called a capital gain. Half of it's taxable, so $50,000, at whatever the marginal tax rate is. So again, in this example, you would pay on $100, $27. You would keep $73. So half of it's taxed versus an interest income. Dividends, they're taxed in between. Okay, they're taxed better than interest, but not as favorable as capital gains. And then the last one is return of capital. Return of capital is a structure where you don't pay tax in the year that you receive it, but rather when you dispose of the asset. And I spent, I think, 2 sessions ago, I think I did a full talk on return of capital. Benefit of this is that, again, you don't pay tax in the year you earn it. You can realize them as capital gains or losses in the future. You can also turn interest income into capital gains, which means you can also use any carry forward capital losses against it. So it's a very attractive distribution in terms of tax. Okay. Now, just again, really quickly, same type of example. If you earn $100,000 in interest income, we just learned that you lose roughly 53% if you're on the top bracket. So again, this is the amount you put in your pocket. Capital gains, you put this amount in your pocket, and there's the dividends, roughly right in the middle. Okay, so when we design portfolios, what we try and do is we try and put the investments that might be taxed at a higher amount in, say, an RSP, a RIF, a LIP, a LIRA, maybe some of it in a TFSA, although we would prefer to have more growth investments in a tax-free savings account. But we want to try and shelter this type of income as best you can. And then your capital gain investments and your eligible dividends, those would be securities that you might own in a non-registered account, corporate account, personal investment accounts, maybe again, even TFSAs, because these generally have more growth in general. Okay. So again, where you situate these types of investments means or determines how much you get to keep in your pocket. All right. So these are just the taxation of your investments. So now let's just go back and say, okay, well, how do we read our statements when all of these mechanisms are in play? Okay. So the first thing I'm going to talk about, I have about 5 or 6 slides left, folks. So just hang tight again. I think this is where everything comes together on this section. So the big thing that we've been talking about with clients is price return versus total return. So when you look at price return, it just simply measures the change in a stock price or change in what we call NAV. So net asset value, or your daily price of whatever investment you're holding. So if you owned a stock or a security and you bought it for $50 and it went up to $60, the stock gain is $10, which represents a 20% increase on that position. Okay, bought it for 50, currently at 60, that $10 change, that's your gain. That's what's called price return. Okay. Now, on your statement, when you look at an investment, it will often just show you price return. Here's your cost. Here's what it's valued at. The difference is the gain. And I say that somewhat because I'm going to confuse you a little bit more on my next slide when I talk about the change on book value. So hang tight. Okay. The second piece of the returns is what we call total return. Now, this is important if you happen to be owning an investment that happens to distribute any of their profits, whether it's an interest, dividend, capital gains, or return of capital. Okay. So I use an example. That example I just used, you bought a stock for $50, goes up to 60. On paper, you're up 20%. But if you also are receiving a 5% dividend throughout the year, okay, now you made 10% or 20%, the gain between the purchase price you bought it at and the current value, that's your realized or unrealized capital gain, plus the dividend you would have to add on to that. Now, for a lot of investors in Canada, they missed that last part. And I'm going to give you 2 examples of how that works. Okay. So first thing, let's unpack book value. Okay. And so far, let's see. I'm going to go back to the questions after, but nothing on this so far. If you have questions on this topic, guys, please plug it in. So book value, generally speaking, book value means what did I buy it for and what it's valued at. And that's how a lot of people look at their statements. Okay. They simply look at what the book value is and market value, and then just take the difference. And for a lot of investments, that's okay. Okay. But where the challenge comes in is if you happen to receive a distribution that's reinvested and you pay tax on that in any given year. Okay. So let's look at this example. So let's say on January 1st, 2022, you made an initial investment of $100,000. Okay. and you received and reinvested dividends through 2022, okay, that total $5,000. Now, let's assume this is in a non-registered account. That $5,000, you're going to have to pay tax in the year that you received it if it's in a non-registered account. Okay, that's what a tax slip would do, or would be distributed that you give to the accountant. So now your actual account has the initial 100 plus the $5,000 in dividends. Okay. Now the current market value also went up over that year by $10,000. So now your account that started at 100 is now worth 115,000, which is the $10,000 of growth and the $5,000 of the dividend that was received. Okay. Now, because you pay tax on that $5,000, it's considered after-tax dollars. Okay, so it gets added to your book value. So your book value now is 105. Your market value is 115. So again, if you just typically deduct or subtract them, you're going to look like you've made roughly 10%. Okay, the difference between 105 and 115. But the reality, if you actually look at a property, it's what you invested, okay, or your market value minus what you invested, and that gain, whether it's from realized capital gains or unrealized capital gains and dividends, that's your true return. So in this case, sorry guys, in this case, your return is actually 15% because of the dividend. Does that make sense? I see some people are actually typing in, they're saying, yeah, that makes sense. Okay, perfect. So again, book value, you can't just simply look at book value and market value and subtract the difference and say, I'm up this amount. Okay. Now, not to complicate it, but one other thing that affects your book value is if you actually add more money to the investment. So as an example, if you bought a stock and it was $10, okay, you had 100 shares, and it went up to $20 and you said, oh, I'm going to buy another 100 shares. Okay, so you double your shares. Well, your first batch would be at $10. Your second batch would be at $20, and your average price would be at $15. So now simply by adding more money or investing more money into an investment, your book value changes. Okay, so this is why it's important that we look at, whether it's time weighted, money weighted, or what have you, to actually figure out these numbers. They get a little bit complicated. So if you ever have questions about a certain investments, please ask. We can actually walk through what the overall or total return is on those portfolios. And I'm going to give you two examples here about the dividend piece. Okay. So again, dividends, moving on from book value to just how dividend yields affect it. So dividend yields are pretty simple. On the S&P 500 today, the average dividend yield is roughly 1.8%. For those of you that don't understand the dividend yield or the distribution yield, what it basically means is how much of a distribution are you receiving based on the current share price. If you have an investment that's $100 and it's paying you $5 a year, then that distribution yield is 5%. Okay, that investment or company is sharing the profits with you. Okay, so let's look at an example. So Coca-Cola as an example. This is a chart that shows the price change versus the total return. Okay, Coca-Cola pays somewhere in the neighborhood of 3 to 4%, 4% or so. Okay, so this looks over a 3-year period. And if you looked at just the price change of Coca-Cola, which is the orange line, the stock has gained 25% over 3 years, or roughly 8%. Okay, which is okay, but not as great as the markets and the equity markets. Okay, on your statement, that's how it was shown. You bought the Coca-Cola 3 years ago. Your gain on the statement, let's say up 25%, not including any currency fluctuations. Okay, but because Coca-Cola is also paying roughly a 3 to 3.5% dividend, you've also received roughly an extra 9% over the 3 years. Okay, that gets paid into cash or what have you, and gets reinvested into other investments. So Coca-Cola over the 3 years in terms of price is up 25.5%. But when you factor in the dividend, it's actually up almost 35%. So this is the true return. Okay. Now I'm going to show another example, and this is one that a lot of folks here invested. Okay. Now this is the Rockbridge private debt pool, the alternative pool that a lot of our clients have. Okay. Now this could be a GIC, it could be a bond, it could be something that distributes more income than it does capital appreciation. Okay. So this is an example this is a real example that I took that one of our clients had bought in June of 2021. So roughly 5 years ago, just short of 5 years ago. On the statement, it would show a gain of 2% over 5 years. Okay, roughly $400, $460. So as an investor, they might look at it and say, this is a terrible investment. I'm up 2%. Markets are up more. Okay, why am I owning it? Well, this return is what's called unrealized capital gains. This is only part of the equation. Okay. Over the last 5 years, this investment, and I'm using this as an example, but again, this could be any investment that distributes interest income or what have you. It's paid out dividends or whatever, whatever you call it. Okay. So over the period of time, over the last 5 years, there's the investment. Here's where it is today. This investment has paid out dividends. I didn't count them. How many is there? I don't know. What is there? There's almost every quarter for the last 5 years. You got almost 20 distributions. Okay. So these are the distributions that have happened, every quarter for the last 5 years. Another $6,400 was paid into the account, roughly speaking. Okay. So this investor received 2% in unrealized capital gains. So again, the market went up, okay, or the portfolio went up $463 of the investment, plus they received another $6,400. So in total, this investment has distributed or gained $6,800 of growth, right? When you factor in the dividends, but unfortunately, it's not reflected here. So it's averaged over the last 5 years, just over 6% annualized, or roughly 31% over 5 years. So this is the reason why I stress it's really important to dig into some of these or ask questions if anybody has any inquiries, is to say, hey, help me understand. I'm not just talking Rockbridge. I'm just saying investments in general, if you have them. Sometimes the statement only tells a story. And that's the reason we go through it when we're chatting with you to say, hey, here's what your overall return is. Here's how everything has contributed to the gains within the portfolio. And the gains come from a number of different places. Unrealized capital gains. So the price goes up. Okay. Then also there's distributions. There's interest income, dividends, capital gains, return of capital that may be paid in there at different periods throughout the year. So at the end of the day, we always look at, hey, what was invested and what is it worth today? And the difference is the gain. Okay. So we look at it more from a holistic point of view. All right. So I'm going to pause it. That's the last slide that I had. So again, today we gave a little bit of an economic outlook. Number one, we talked about where do we go from here on a go forward basis. Okay. We talked a little bit about the US Fed and Bank of Canada rates. And then we just, we did an educational session here for the last 10, 15 minutes about, statements and making sure that we're understanding them or how we can understand them better. Now, we're always here for a conversation. If you have questions, please don't hesitate to reach out. But again, I think this is important because as investors, and I'm the same, I make decisions based on the data that I'm personally interpreting. And if for whatever reason I'm not seeing everything in the numbers, or I'm not interpreting, the situation correctly, me personally, I'm going to make decisions based on that data. And that data, if it's not fully correct, I'm making misinformed decisions. So we always want to make sure that we provide clear direction and clear numbers so that we can actually make well-informed decisions, not just about investments, but investments, tax, cash flow, retirement, and so on. Okay. So really understanding, taking a step back and making sure that, again, we're understanding all the details so we can actually make a well-informed decision. Okay. So I'm going to look at some questions. I've actually had quite a few come in, so let me have a look here. So I see. So I have somebody here. It's a little bit different. It's talking about some estate taxes, early distributions of inheritance. And they're just saying, hey, then this is a good segue. They're talking about, hey, I'm seeing stuff, YouTube lectures and so on attribution rules. Attribution rules essentially is, gifting or giving money to, say, a spouse or someone else, but still retaining control. You're circumventing the tax situation by getting it in somebody else's name. Okay. Now, if you are doing that, and that is what you're trying to do, is minimize tax, there are onboard ways of doing that through spousal loans or loan arrangements where the government allows you to do that if you pay a prescribed rate. We're not talking about that here, but again, if there's people here saying, I'm trying to get income out of my hands into somebody else's, can I do that? The answer is yes, but you have to do it, above board. The second one here is what we're talking about. How do I get money to the next generation? So if you are gifting, folks, you can gift to the next generation. I can gift to my daughter, but it's no strings attached. Once I gift that money to my daughter, I have no control over it. She fully owns it. When I gift that cash, those proceeds, to generate the cash, if I'm selling something or drawing it out of an RSP, which we don't always suggest, but if I'm triggering the taxes, I pay for the taxes, and I'm gifting after tax money. And I see this all the time. We actually have a lot of clients that are actually gifting with warm hands versus cold hands. They're saying, hey, I want to help, somebody, usually it's kids, grandkids, or so on. I want to help them with a property. I want to help them, enjoy this money today rather than when I passed away. So the benefit, and again, I did a session on this a little bit ago, but for the individual that's doing the gifting, the reason they like it is they minimize some estate taxes. Okay. Number two, they get to see their beneficiaries, kids, whoever enjoyed in their lifetime. So there's a personal benefit. But what I would say from a planning point of view, from a professional point of view, is what I would say is if you are going to do this, it's really important to make sure that you're not impacting your future cash flow, your future retirement needs by giving away too much money today. So what we do with our families is what we'll do is we'll say, okay, great. Let's look at your situation today. And let's assume that you gift X amount of your assets today, assuming everything else stays normal. Here's your expenses. Here's your goals and so on. Are you still going to be able to have enough money, cash flow to deal with that through various stages of your life? So what we do is we do the analysis before that gift is done. Okay. And then the last piece I would say about gifting is it's important if there are maybe partners or spouses, if it's important for you to protect that money or that gift from potential creditors, breakdown in partnerships or marriages or what have you, that you explore those options before you gift those assets. Okay. So a little long-winded answer to that question, but it's a complicated question that deserves more than just a simple response. Okay. I had a comment here from a fellow. It's a tongue-in-cheek comment. No, it's not based on my income, but I like that comment. Somebody has asked here, does the investment company do the ACB as dividends are distributed? That's a very good question. Does your book value change as distributions are provided? And the answer to that is yes and no. Generally, what you see throughout the years, you may see a book value adjustment that will happen after dividends are paid in. If it's a typical dividend from say just a simple stock, right? It's paying out a dividend. It might adjust sooner, but if you're in any pooled investments, an ETF or perhaps a REIT or a mutual fund, a lot of those book value adjustments will actually happen near the end of the year because they don't fully know what the breakdown of that distribution is going to be until later in the year, if not early into the new year. So some happen sooner and others happen later. So a very good question. Another question. Yeah, somebody else said, as an investor, can we see total return of investments or the portfolio in the online? So the answer to that, some of them would show overall return, but not all of them. The challenge with online portals is no two portals are the same, and everyone has their issues. So our IT team, which a lot of money is invested into our technology platform here at Harbourfront, It's been ongoing for probably a couple years where they're trying to find a new platform. We give feedback to say, hey, here's the improvements we'd like to see as investors, me included. So right now, the best way to actually get the returns would be through us at this stage. Again, some of the data on the portals would show it, but again, it wouldn't paint the full picture. So I would suggest to reach out to the advisor. So another question about tax. If I donate shares, there should be no tax on the gain, and yet I get a tax slip. How do I handle the tax slip? Great question. I would refer to your accountant on that one. There is a mechanism. You do actually pay tax, that you get a tax credit to offset it. So again, I would direct that one to the accountant. That's a great question, but everything should be somewhat of a wash when you donate shares in kind. Again, you can defer taxes and also get the tax receipt. Another question here. Updated view to churn. Yeah, great. Again, just a general comment about reporting. No sweat. And again, I can comment about that offline. And then another one here. I had the last one. Again, another estate question. Got great questions today, guys. Is there a way of giving investments or funds to our kids and protecting it from being shared with the kids' spouses if the marriage is dissolved? So yes, and I assume you're talking about gifting while you're alive. So inheritance or gifts, there's been changes to the Matrimonial Act that states that inheritances or gifts generally don't form part of family property. Okay, that's what it says. Where the challenge lies is when that gift is received and it starts getting commingled in their assets, or maybe it's paying down a mortgage for that couple. It's a lot harder to determine where that gift may have gone. So a future, breakdown of that partnership, marriage, what have you, it could be complicated and it could get commingled. So if your wish is to actually leave money to your specific child, then I would maybe talk to maybe a lawyer or what have you. You think there are different ways to actually provide that gift with protecting it a little bit. So, and then from an estate point of view, again, same thing in inheritance. If it's left to them directly, again, doesn't form part of the family assets. But again, getting commingled complicates things, especially if years and years go by. So again, if this is important to you, and I would suggest reaching out and we can chat a little bit further to make sure that the intention or what you're hoping to have happen, that you're doing everything that you can to structure it in an appropriate way, allows the intended use of your funds to occur as you hope. So, okay. So I'm going to wrap it up there, guys. Like I said, great session today. Thank you for the questions. If you do have follow-up questions, please feel free to reach out. You can email me or call us as well, whatever's easiest, and we'll do our best to get back to you. So once again, we'll do another session like this, likely in June. We might take a break over the summer, given the attendance numbers will likely be a little weaker with people out of town, but we'll just judge it on what happens in the overall economy and in markets. But again, you can still stay tuned to my weekly commentaries, which I will continue to send out. And then again, if you have any questions, comments, feel free to reach out directly. I appreciate you guys joining us. I appreciate you giving us the time today. Again, I wish you guys all the best. Have a wonderful May long weekend. If you're traveling, please be safe, and we'll catch you on the flip side. You guys take care. Until next time.